Dividend income can and should play a vital role in any investor's portfolio. You don't have to be fully committed to only dividend stocks. In fact, I would rather you take a much more balanced approach. That's the approach that I take. But when you invest in dividend stocks, these are usually companies that are much more reliable. These are companies that are stable. They have reliable, consistent, and growing free cash flow, because if they didn't, they wouldn't be able to pay a dividend. However, when it comes to getting that dividend exposure, you can do it one of two ways. You can invest in individual stocks that pay dividends, or you can invest in dividend-focused ETFs. And in today's video, we're going to talk about 10 of the best dividend-focused ETFs on the market today. But before we do me a huge favor. Click that like button down below and show your appreciation, and also subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's get back to our video where I'm going to quickly go through 10 of the best dividend-focused ETFs on the market today. Some of these ETFs are going to take a balanced dividend approach. Some of these will be focused on dividend growth stocks. Some will be focused on high yield, and some will be focused on delivering huge income. And so with that being said, we're going to go through each of these ETFs, give you the performance, give you the breakdown of the sectors, the top holdings, and of course, the dividend stats. So let's begin with Dividend ETF number 1, which is going to be the Schwab US Dividend Equity ETF, stock ticker SCHD. Why not do a dividend-focused ETF video and begin with the king of dividend ETFs, at least in my opinion. After all, SCHD is one of the top holdings within my portfolio, a foundational position. The ETF currently has assets under management of $67 billion, an expense ratio of 0.06%, which you're going to see a lot of low-cost ETFs here today. Over the past 12 months, shares of SCHD are relatively even. Over the past 5 years, they're up roughly 90%. The focus when it comes to SCHD is that balanced approach. They focus on high yield, they focus on dividend growth, and they focus on stability. The top sectors include energy, consumer staples, healthcare, industrials, and then technology. I talk about it a lot, with SCHD being a great complement to tech-heavy portfolios, or even the likes of SPY, the S&P 500, because technology isn't a major focus. The top holdings include ConocoPhillips, Coca-Cola, Lockheed Martin, Verizon, Altria, Chevron, the Home Depot, AbbVie, Amgen, and Merck. In total, the ETF has 103 positions, with the top 10 accounting for 41%. In terms of the dividend, SCHD is giving you a 4% dividend yield, with a 5-year dividend growth rate at 11.4% and 13 consecutive years of dividend growth. It checks a lot of boxes. And that brings us to Dividend ETF number 2, which is going to be the Vanguard Dividend Appreciation ETF, stock ticker VIG. And as you could probably already tell, this ETF, their focal point is on dividend appreciation, companies that pay reliable, growing dividends. The ETF has assets under management of $102 billion, an expense ratio of just 0.05%, and over the past 12 months, shares of VIG have climbed 9%. Over the past 5 years, 89%. The top sectors include technology, followed by financials, healthcare, consumer staples, and industrials rounding out the top 5. The top holdings include Apple, Microsoft, Broadcom, JPMorgan, Eli Lilly, Visa, ExxonMobil, United Health, MasterCard, and Costco. In total, the ETF has 341 positions, with the top 10 accounting for 31%. So a nice little blend of higher growth type stocks focused less on yield. In terms of the dividend, you're going to see that play out right here because the yield is currently below 2% at 1.9%. But they do have solid dividend growth with a 5-year dividend growth rate of 11.1% and 11 consecutive years of dividend growth. And that leads us to Dividend ETF number 3, which is going to be the Vanguard High Dividend Yield ETF, stock ticker VYM. So if you're an investor that's looking more for yield and less for growth or volatility, then VYM may be right down your aisle, because this ETF is going to give you a much higher dividend yield, but that also comes with less dividend growth, at least most of the time. This ETF currently has assets under management of $73 billion, an expense ratio of just 0.06%, and over the past 12 months, shares are up 7%. Over the past 5 years, a total return of 91%. Of the 3 ETFs we've looked at so far, VYM has actually given you the best performance over the past 5 years in terms of total return, not something I expect over the course of the next 5 years. The top sectors include financials, healthcare, technology, consumer staples, and industrials. The top holdings include Broadcom, JPMorgan, ExxonMobil, United Health, Procter & Gamble, Johnson & Johnson, Walmart, AbbVie, the Home Depot, and Coca-Cola. In total, the ETF has 592 positions, with the top 10 accounting for 24% of the ETF. In terms of the dividend, the ETF currently yields 3%, with a 5-year dividend growth rate around 2% and 14 consecutive years of dividend growth. So you get a nice little yield here, but very little in terms of dividend growth. And I think that just really speaks to the quality, again, of SCHD, because with SCHD, you have a higher yield than most high yield focused ETFs and stronger dividend growth than most dividend growth focused ETFs. And with that, that brings us to Dividend ETF number 4, which is going to be the iShares Core Dividend Growth ETF, stock ticker DGRO. And as you can imagine, this ETF is focused on just that, dividend growth. So it's going to align a lot more closely with that of VIG and less with that of VYM. The ETF currently has assets under management of $30 billion. It has an expense ratio of 0.08%, and over the past 12 months, shares are up 7.5%, with a 5-year total return of 91%. Although DGRO is smaller in terms of size compared to its close competitor in VIG, it has actually outperformed, albeit slightly, its counterpart over the past 5 years. The top sectors include financials, technology, healthcare, consumer staples, and industrials. The top holdings include Microsoft, JPMorgan, Exxon, Apple, J&J, Broadcom, AbbVie, Procter & Gamble, the Home Depot, and CME Group. In total, the ETF has 417 positions, with the top 10 accounting for a little more than 25%. In terms of the dividend, DGRO is going to give you a 2.3% dividend yield with a 5-year dividend growth rate of 7.6% and 10 consecutive years of dividend growth. And that leads us to Dividend ETF number 5, which is going to be the iShares Core High Dividend ETF, stock ticker HDV. Again, we keep seesawing back from dividend growth focused back to high yield. And as you can imagine, this one is more focused on high yield. And its close competitor is going to be the Vanguard High Yield ETF, which we looked at a little earlier, which was VYM. HDV currently has assets under management of $11 billion, so again, smaller than its Vanguard counterpart, and an expense ratio of 0.08%. Over the past 12 months, HDV is up 6%, and over the past 5 years, bringing in a total return of 75%. The top sectors include consumer staples, followed by energy, healthcare, financials, and utilities rounding out the top 5, with the top 10 holdings amounting to Exxon, J&J, AbbVie, Progressive, Chevron, Philip Morris, Procter & Gamble, CME Group, AT&T, and Coca-Cola. Much more in terms of legacy-type companies here. In total, the ETF has just 82 positions, with the top 10 amounting to nearly 50%. In terms of the dividend, it gives you a dividend yield of 3.5%, with a low 5-year dividend growth rate of roughly 4.5%, and 3 consecutive years of dividend growth. But again, with this ETF, dividend growth isn't so much the focus. And now for Dividend ETF number 6 is going to be the WisdomTree U.S. Quality Dividend Growth ETF, stock ticker DGRW. So again, the focus here is a little bit more of a balanced approach. With DGRW, the focus definitely is not on high yield. They are looking for companies that pay a solid dividend, but also can give you solid share price appreciation. That's the focal point. The ETF has assets under management of $14.5 billion, with a little bit of a higher expense ratio at 0.28%. Over the past 12 months, the ETF's up 7%, and over the past 5 years, a total return of 104%, the highest on our list. And you're going to see why right now, because the ETF's top sector is technology. And over the past few years, technology has been the clear leader of the S&P 500. After technology, consumer staples, so a nice balance there, followed by industrials, healthcare, and financials rounding out the top 5. The top 10 holdings include Microsoft, Exxon, Apple, Procter & Gamble, Nvidia, Philip Morris, Chevron, the Home Depot, Walmart, and Merck. Those top 10 holdings account for 36%, and the ETF has slightly over 300 total positions. In terms of the dividend, the ETF currently gives you a low dividend yield of just 1.6% and 5-year dividend growth rate of 4% there. Because this ETF goes through a multitude of changes, the dividend can vary, hence the 1-year dividend growth stat. So far, all of the ETFs that we have discussed thus far have all been part of my portfolio at one point or another. And if you're interested in seeing all of the positions within my portfolio, what I'm buying, what I'm selling from a stock and ETF perspective, consider becoming a subscriber to the Stock Investor's Edge newsletter and join our Discord. Check out the link down in the description below. And that leads us to Dividend ETF number 7, which is going to be the Spider Portfolio S&P 500 High Dividend ETF, stock ticker SPYD. So again, now we're going back to high yield being the focus. And here, the company has to be in the S&P 500 to be part of this ETF. SPYD currently has assets under management of $6.6 billion, a low expense ratio of 0.07%, and over the past 12 months, the ETF has climbed 6% with a 5-year total return just shy of 100% at 98%. The top sectors include real estate, which is not something we have seen on the list here yet, followed by utilities, consumer staples, financials, and energy. The top holdings include Philip Morris, Consolidated Edison, AT&T, CVS, Exelon Corp, Crown Castle, AbbVie, Altria Group, Kenvue, WEC Energy, and with those positions, they amount to just 16%. So this is an ETF that's much more distributed across all of the components, and there's 80 total holdings within the ETF. In terms of the dividend, you're going to get a nice high yield here of 4.6%, and the focus is not on dividend growth whatsoever, as the 5-year dividend growth rate is only at 1.1%. So again, an ETF not focused on dividend growth by any means, and more focused on yield. And that brings us to Dividend ETF number 8, which is going to be the iShares Select Dividend ETF, stock ticker DVY. So with this one, we're taking more of a balanced approach. It's not an overextending focus on high yield. It's not an overextending focus on dividend growth stocks. One of the key components, though, is to be included or up for entering into this ETF, you have to have at least 5 years of dividend payments. The ETF has assets under management of $19 billion, an expense ratio on the highest of the list at 0.38%. But over the past 12 months, shares have climbed 7% with a 5-year total return sitting at 97%. The top sectors include utilities, financials, consumer staples, consumer discretionary, and communication. So some of those we haven't seen on the list thus far. The top holdings include Altria, Ford, Edison, Verizon, Pfizer, Lyondell, Eversource, Dominion Energy, Prudential Financial, and First Energy Corp. In total, there's 107 positions in the ETF, with the top 10 accounting for nearly 20%. In terms of the dividend, you're getting a nice dividend yield of 3.8% with a 5-year dividend growth rate at 5.7%. So a nice little blend of a higher dividend yield and still getting a decent amount of dividend growth. And that brings us to Dividend ETF number 9, which is going to be the Amplify Enhanced Dividend Income ETF, stock ticker DIVO. Now with these last final 2 dividend-focused ETFs that we're going to look at, these ones are primarily spent on sending out huge amounts of cash flow. Because the underlying approach here, when we're talking about DIVO specifically, is that they are going to own underlying securities, positions that pay solid dividends. But on top of that, they're going to use derivatives, stock options. They're going to sell covered calls, which allow them to bring in more premium income, which is then distributed out to the shareholders. The ETF has assets under management of $4.1 billion and an expense ratio, which is now the highest on our list, of 0.56%. Over the past 12 months, shares are up 7%, and their total return over the past 5 years, 85%. So that's why you got to be careful and pay attention to those expense ratios. If you're paying it and it makes sense from a performance standpoint, then that's A-OK. In terms of top sectors, they include the likes of financials, technology, consumer discretionary, industrials, and communication. The top 10 holdings include short-term treasuries, followed by Caterpillar, Visa, CME Group, American Express, Microsoft, JPMorgan, Goldman Sachs, the Home Depot, and IBM. In total, the ETF only has 34 positions, with the top 10 accounting for more than 50%. In terms of the dividend, you're getting a nice juicy yield, close to 5%. However, the 5-year dividend growth rate appears to be negative, but this is because the yield is so predicated on the success of the option strategy. If those strategies are unsuccessful, the income they have to distribute can drop. So it's not a consistent dividend yield you get with Devo. And that brings us to ETF number 10, which is going to be the JPMorgan Equity Premium Income ETF, also known as JEPI. JEPI is the ETF that put option selling and this high income distribution type ETF on the map. In terms of JEPI, they have assets under management of $39 billion, an expense ratio of 0.35%, and over the past 12 months, shares are even. And over the past 5 years, a total return just shy of 70%. So from a performance standpoint, JEPI has actually performed the worst over the past 5 years out of all 10 dividend-focused ETFs we have looked at here today. The top sectors include technology, healthcare, industrials, financials, and consumer discretionary. The top holdings include JPMorgan Bonds, MasterCard, Visa, Progressive, Train Technologies, AbbVie, Southern Company, ServiceNow, Microsoft, and Amazon. In total, the ETF has 131 positions, with the top 10 accounting for just 16%. In terms of the dividend, you're getting a nice juicy yield, the highest on today's list at nearly 8%. And again, like Devo, the dividend growth is predicated on the success of the option strategy, as distributions are paid out on a monthly basis. So there we just looked at 10 very different dividend-focused ETFs. Some focused on dividend growth, some focused on high yield, some on huge distribution income, and some taking more of a balanced approach. By no means do you need to own all 10 of these. Find what works for you. Find what fits your strategy. And down in the comments, let me know what your top 3 dividend-focused ETFs would be. Whether they're on this list or not, I would love to hear it down in the comment section. And if you haven't done so, subscribe to my newsletter. Click that like button down below, and we'll see you in the next one. Take care.